Good evening, everyone, and thank you for joining us for today's webinar, Economist Update 2021 in Review and 2022 Outlook. If you have any questions during today's webcast, please submit these using the Q&A function, and Marcus will try his best to answer them towards the second half of the session. Before we get started, I'd like to pass over to Helen Mackay, Chairperson of the Edinburgh Lothians Fife District Centre, who will say a few words. Over to you, Helen.
Thanks, Heather, and welcome to this evening's event, which is in conjunction with Chartered Institute of Securities and Investments. It's really good to have some events lined up again for 2022, and we will share some details on that later on tonight. We kick-started 2021 with Sebastian Burnside to review the economic climate in 2020, which was an unprecedented year. And have a look forward to 2021, which wasn't much better, really, was it? So this was so successful, we thought we would see how 2021 looked and what is planned for this year. And it's a great pleasure to have his colleague, Marcus Wright, who's a senior economist at NatWest, to share his thoughts. Marcus has a first-class degree in economic science and has over 17 years professional experience, so I think we're in safe hands. We also have Neil Henderson, who's a member of the committee, standing by to take your questions for the Q&A session at the end. So I encourage you all to take this opportunity to ask as many questions as possible and take advantage of Marcus's knowledge. So over to you, Marcus.
Thank you very much, Helen. Thank you, Neil. Thank you, Heather. Hi, everyone. Evening. I think it's appropriate to call. Yeah, I'd forgot that Seb had done this last year, and I got to follow Seb. That just adds to the nervousness. Anyway, okay, so I'm going to try and talk a little bit about what we learned over the past year, which is probably a lot more than I initially realised, and maybe the real learnings will only come with much more time, as is so often the case with these things. And talk a good bit about 2022, the year ahead. I've set a couple of questions, well, more than a couple. The questions that we're getting from well, really internally customers alike. What's the agenda for 2022? So I've structured those around 8 questions. We'll see if we get through them. There's certainly plenty to talk about. Right, let me get my screen sharing on the go, because it being an economist presentation, we are going to require the use of graphs. Right, here we go. I'll do that one, do that one, do that, I'll do that, I'll do that. Bear with. I'll go from beginning. Oh, excellent. We're away. Okay. Before I get into my questions, let's talk a little bit about 2021. So if we rewind the clock back 12 months, we were just starting to learn a bit more about the nature of the pandemic and in particular its impact on the recovery. We're starting to see hints that actually the labour market, the all crucial labour market, was holding up rather well. And so the big fears over huge increases in joblessness we're starting to realise that they might not just materialise. And it wasn't just about our acceptance as a society, that we were just not going to tolerate high levels of joblessness amidst this pandemic. The labour market was stunning. It was starting to show signs that it was regaining its mojo, and job growth was good. And that is really one of the key lessons when we look back on 2021. We'd recognised that reasonably early on, we have to say. Other forecasters hadn't, and some of the estimates around joblessness had remained quite high, even going in quite far into the year. That the expiry of furlough, that deadline, that looming deadline of furlough, had many fearing a big rise in joblessness. The data showed quite the opposite, the exact opposite, in fact. The pace of redundancies in the 3 months to November, so straddling the end of furlough, was the lowest since at least 1995. The labour market, again and again and again over the past 10 years, has confounded expectations. And that was certainly a key learning over the course of 2021. And it does shape a lot about 2022 as well. What else have we learned over the past year? The state of household balance sheets matter. So it's not just that the labour markets confounded expectations, it's that the performance of asset markets, the feared big price corrections in commercial property, in residential property, just haven't happened. And again, it's quite the opposite. Housing market's been absolutely, it's been very robust. Demand's been very firm, supported by low rates, strong household balance sheets, and a desire to change your, for many, the type of house they live in, adjusting to a new working world. We think there's life left in that. And we think the housing market, it's cooling, it's certainly not crashing, and it's quite gently transited to a sort of steady pace of activity. I think that's the case over 2022. And if anything, the pace of sort of activity levels will remain good, remain healthy. Commercial property, the feared bloodbath in office because we're all working from home. Again, it's just, so far at least, not coming to fruition. Yes, I think there's still a lot to be worked out there. What is the new equilibrium, and what exactly does it mean for office space? There are some who estimate that as many as 1 in 10 of offices across the UK might become redundant in some form in the coming years. But again, the transition and working the whole thing out so far is going reasonably well. In the latter half of 2021, we haven't seen capital growth across commercial real estate for over a decade. We haven't seen capital growth that strong for over a decade, which is quite remarkable. And it's not just confined to warehouses and industrial, as we shop online more. It's actually happening in offices and even parts of retail. So the retail warehouses, the big, sort of box and a big box and a door and a few car parking spaces, doing rather well. So that's been the big learning, that the degree of policy support needs to be evaluated for its quantum. Just how big is it, and is this really going to salvage things? The strength of household balance sheets, the underlying dynamics in the labour market. It's been a real, a period for many economists, a period of reflection, not to put too much emphasis on the downsides. What else have we learned about 2021? Crucially, most importantly, and again, this does shape 2022, things were normalising. So the last cut of the performance of the economy we have is November, so immediately pre-Omicron. We've got GDP. What does it tell us? As I say, it tells us that things were normalising at a reasonable pace. Growth was broad-based. So when you break down into the sectors in November, you see consumer-facing services were coming back strong. So appetite, consumer caution was in retreat, appetite was returning to do the things that we used to do. Flights were recovering. But away from that, the sectors who had been less affected, so think professional and technical services, think finance and insurance, think parts of IT, doing rather well. So strength in those areas. And that makes sense because the labour market's been so good. Firms in these sectors want to hire, and they want to hire for a reason. Demand is good, order books are good, and they're confident about 2022, about the strength of underlying demand. And then a final group that you might call those impacted by supply chains, the construction sector, manufacturing. Supply chain pressures had alleviated, perhaps just short-lived, but it did enable them to stage a robust rebound through November. So real broad-based growth, consumer-facing services, professional business services, manufacturing, construction, all doing rather well. That gives us a glimpse as to what lies in the not too distant future as we put Omicron behind us. And that shapes a lot of 2022 because we think those things come back in to play, that sort of returning appetite, the willingness to do the things we want to do, the ongoing recovery, the completion of the recovery in consumer-facing services, which are still 5% below their pre-COVID level. So a bit of track to work on there. But as I say, we think those things come back in pretty short order and shape what should be a reasonable growth outlook for 2022. We think the economy effectively picks up on the momentum that it had as we came into Omicron. What else have we learned? Again, we've learned not to underestimate the COVID. Of course, it's an obvious lesson. You take the optimistic spin, and this actually speaks to one of my questions on the year ahead, that this is, the worst is behind us, that we're going to get a good road ahead of us for the recovery. Pfizer's going to manufacture 4 billion vaccines this year. Antiviral pills really are a game changer for reducing substantially hospitalizations and deaths. So we think, subject to the usual caveat that COVID has surprised us again and again, we think that really the worst is behind us, and we now have, as I say, clean road ahead for 2022. But yeah, again, that is a key lesson. I think the other lesson we've learned is, and this would have gotten a lot more focus had it not been for COVID, our adjustment to our new trading arrangements has been difficult. A lot of firms, particularly in the first half of the year, found it difficult adjusting to new requirements around paperwork, higher costs. Things seem to get a little bit better in the second half, only for new tighter border customs issues to arise, as we know, at the beginning of this month. That's going to be a long-standing issue for the UK and for our firms that trade. There's no getting away from that. And maybe the learning is, for those forecasts that have pointed to an impact of Brexit, saying, look, life goes on, the UK economy will continue to grow, it just might not grow at the pace that you otherwise would have expected. You've possibly sacrificed a little by way of output, of dynamism. Some of the initial, for that first year, some of the data might support a view along those lines. We have continued to recover, growth has continued, and there's certainly optimism about 2022. But at the margins, in and around what's happening with our firms that trade with Europe, there are some issues, and they're continuing to be worked through and will be with us for some time. So I think that's another key lesson. Try and cast your eyes away from these shores. There are geopolitical tensions mounting, not just in Eastern Europe, but across the Taiwanese Strait. If data is the new oil, then semiconductors are mightily important, and the technological frontier lies in Taiwan. Both the US and China have semiconductors, and all that is the enabler for, whether it's AI, the advance of really any part of technology. It's central to so much of what we expect to achieve in the coming decade, including the climate transition. Semiconductors really are the enabler. So that is something to be focused on really permanently. I think, one of the other lessons from COVID was listen to those voices at the margin, right? There were plenty of voices in the run-up to COVID saying, look, the risks are really rising around a pandemic. They just weren't being listened to. Some maybe weren't choosing the right channels to make their voice heard, but they were there. We just weren't listening to them. So that's probably another one of the lessons. Right, that's probably decent enough for a year in review. There's probably lots more we could talk about. Let's get rid of that. Don't need that. Right. So this one, questions for 2022. Will we put the pandemic in the rearview mirror? Probably answered that so far, I say. We think sort of cautious optimism, a yes. How strong will the economic recovery be? Will vacancies put the brakes on the recovery? The year of the squeeze, we talk a little bit about that. Supply problems, we'll see if there'll be any let up in those. If there's more to come from November's alleviation in some of the supply problems. Trade performance, rates, of course, the big debate, and the climate transition post COP26. What can we expect with respect to the UK? So yeah, so this is one of the many angles you can think about this, and I've talked about the positives that should lead to us being able to put this behind us. And I think in the wrap up, as we look back on particularly the past couple months and the actual outturn of Omicron, again, some of the initial expectations and some of the modelling that was done and the calls for lockdowns, I think there's like a worthwhile review and evaluation of that to be done in preparation for the next pandemic, because it's been a case of, well, the reality has fallen way short of the fears, even the more optimistic ones. And I think I think that will be a key point. It's probably for another day, but 2022 should see us start to evaluate our response to that more vigorously. And it will be important if the chances of further pandemics have increased. despite our ability to deal with them nimbly through vaccines. It is important that we assess and test our responsiveness to this and how it is the decision-making process that goes along with it. Let's say most optimistically, I think that we've got good sort of a good bit of track on the recovery ahead. Right, growth. What can we expect? So I think really speaking to the modest impact of Omicron, when you look at what forecasts have done in January when they started to adjust their numbers on the back of Omicron, the adjustments were slight. We're talking tenths of a percentage point. So the expectations are still 4.5–5% growth for 2022. I think the important bit underneath that is by the time you get to the particularly second half of the year, quarter to quarter, growth kind of looks normal. You know, that underlying pace, the UK will have settled into a kind of normal pace of growth, really by the second half of the year. We're going to get the post-Omicron bounce. There's quite a bit of ground to make up in consumer-facing services. We'll all return to travel with real gusto, I'm sure, over the course of the year. But underneath that, the UK is kind of settling back into its kind of its speed limit, almost, if you like, roughly the pace that prevailed pre-COVID. And you can see that certainly by this very late 2022 and early 2023. But yeah, so consensus hasn't changed their views. So you're looking at 4.5–5% growth for this year, and it's driven by the consumer. It's the strength in job growth. It's just what I've talked about, doing the things that we used to do so easily and readily, travel and going out, etc., accessing services. That's the driver. Other things, business investment should begin to pick up. There's certainly reason for it to do so, but corporate balance sheets are in really good shape. We have underinvested substantially the past 5 years. Over in the US, I often think where they lead, we follow. The rebound of business investments is really good, very obvious in things like intangible assets, digitization. So a lot of US firms have kicked on with that, and I'm not just talking about the big, the usual suspects, the big tech firms. It's disseminating across the economy, across sectors. I think a bit of that awaits for us. There's the super deduction, there are labour shortages, there's a lot of things pointing in the direction of an upturn in business investment. Now, it is only 10% of the economy. It will never be the driver of the UK economy, but it's an important supporting plank, and it's been absent for some time. But I think that we start to see a bit of recovery of that in 2022, maybe more of a story for 2023. Right, what else have we got? Vacancies, having mentioned it, I talked a lot about the labour market, it's great performance, and there's so many ways you can cut it, and you come up with great figures. I mentioned the redundancies being the lowest pace since at least 1995. Firms' hiring intentions remain strong. It's the flip side, it's the glass half full version of I can't get bodies in the door. Firms are very intent on hiring, and they've remained so through Omicron. That's still coming through loud and clear in the surveys. And it's cross-sector. When you look at vacancies, you sort of pick your sector and you see a great story. Finance and insurance, vacancies haven't been this high since before the crisis. The aforementioned professional business services, of course, and we've all heard the stories about wages being inflated there. Lower paid service sector jobs, same story. And it's there, you can see very clearly the shortage of workers is most acute. It's in hospitality. This is going to last for some time. One of the things that's happened is, and indeed have been really useful in shedding some light on this, job seeker interest in those jobs, including hospitality and cleaning jobs and some jobs in food preparation, construction manufacturing, interest has dropped over the past 12–18 months. And the reasons for that are numerous. People taking the choice to turn to education, doing different things with their careers. Then we've got financial cushions, supporting partners providing financial cushions, caring responsibilities, fears over COVID. So a lot of those jobs are consumer facing. So a kind of myriad of things that have led to a bit of a loss of job seeker interest in those areas, and also feeding what is an increase in economic inactivity. So the number of people on the sidelines are not actively participating in the labour market, but could be, that number has grown. It's up by 600–700,000 since before COVID. So what I think is, some of those people come back but possibly a lot of them don't. And where that points is there's probably a little bit of slack in the labour market, but there just isn't a whole lot. So I think labour shortages, labour issues in a lot of sectors will remain an issue right through this year and beyond. Incentive to automate tasks where it's possible. Yes, we have to pay a bit more, improve conditions in some areas, but that workout is good. It's simply going to take some time. It's not readily solved. A lot of the issues in many of these sectors, take lorry drivers, they were facing problems prior to COVID. Many had left the industry. The relative attractiveness of the industry had declined, and so it's problems compounded by COVID and issues around migration, etc. So, do I think it puts the brakes on the recovery? No, because I think there's some slack, and there'll be migration isn't dried up entirely. So the labour force will continue to grow, but this workout will just be quite difficult, and for many it will be painful. But expect to have plenty of conversations about it in the coming months. The year of the squeeze, right? So we hear a lot about this. How bad will it be? Well, on the surface, it's the worst since at least 2010-11. For those who can remember, post-financial crisis, commodity prices rallied, inflation rose, and it put the real squeeze on households because wages most certainly did not follow. And it made for a real difficult period in the post-crisis recovery. For those that remember and lived through it, you'll probably very much remember it. So it's at surface level, it's material. It really is. What this chart does, quite helpfully, is kind of take all the things that are changing come April. So the uplift in energy prices, the energy price cap. So that'll be 40-50%. Huge. There's changes to benefits and changes around the minimum wage. And we know that the other thing working to the downside, if you like, are tax changes, NI. So you put them all together, break it down by income decile. Where does it leave you? What's the damage? The number is 2%. So that's big. As I say, that is a material drop for all households, regardless of where you apply in income distribution. But look at the poorest 10%. That's a material hit to your disposable income, right? So that's where the concern really lies. And while I expect when the space allows when political discourse, when there's space within it to properly evaluate different approaches the government might take to dealing with this and trying to offset some of the pain many are set to feel. It's also about the pure vigor around the recovery, because this is a bit of a threat to it. If the reaction of consumers is to really rein in the horns, you don't get the rebound that we'd hope for and that is expected to really drive the broader economic recovery. But the other key difference compared to 10 years ago is it's those COVID savings piles. It's the healthiness of balance sheets for many. Yes, we're not talking about the poorest 10% that stand to be hit, but those higher up in income distribution that drive the consumer recovery, their balance sheets are in good shape. They have the room, they have the means to reduce their savings, but dip into those savings pots, maintain their standard of living, maintain their spending levels, right? Because that figure is just enormous. We're talking about 180, 190 billion now excess savings. And it's the habits bit, so even up until, it was only, put it this way, it was only in November that the sort of month-to-month flow of savings into what households were squirreling away, that it looked normal, right? That's November, the first month since the pandemic struck, when how much was being squirreled away was at a normal pace. So households had only just begun to normalise their habits. And in doing so, they'd accumulated massive piles of savings. So for many of those income deciles in the upper half, there's room to adjust, and they can offset a bit of the squeeze. But as I say, it's material. We'll hear plenty about it. And the crucial thing is things don't stop come April. So if inflation is expected to peak in April, 6.5%, actually the pain at the household level amongst those poorer income deciles, it will come later than that. And inflation doesn't make itself felt instantaneously and the pain is acute and then you move on from it. it kind of builds, it's cumulative, and I'm sure we can all, think about our own circumstances and how our own reaction function and how we adjust spending, etc. It's something that really builds, and it will remain an issue right through this year and into 2023. And even with inflation, the retreat it's going to be gradual. You're still talking about inflation higher than 3% come the end of the year. So a long way down from the 6.5% in April, but still material, still above target. Supply chain problems, helpfully, started to get some statisticians that pulled together sort of supply chain pressure indices. So this is a global one. There is a UK focused one as well, and it tells much the same picture. They remain acute. You take the optimistic stance and say, well, is that them kind of leveling off in December there? Potentially. To get under the skin of this, you really have to to kind of business by business, sector by sector. The sense is that these are going to alleviate, but only gradually over the course of 2022, with a key risk, of course, being Omicron outbreak really throwing sand in the gears of Asian production networks, something that we've seen play out time and again over the past 18 months that have led to many of these supply chain issues. These are really significant, and they play into a number of sectors, of course, manufacturing. But as I say, the hope is that they'll gradually come down, and gradually alleviate over the course of this year. But again, there isn't a sort of magic formula for this. Even taking semiconductors, you can't suddenly knock together a semiconductor manufacturing plant. It takes years. Now, the funds being funneled into this are enormous, tens of billions of pounds, but that supply response simply takes some time. And then you get into some of the idiosyncratic issues within that. So cars generally use slightly older generation semiconductors. Well, there aren't a massive amount of plans to build that in this upcoming supply response. They're all sort of closer to the bleeding edge, the stuff that goes into your Apple iPhones and MacBooks, etc. Somewhat encouragingly, electric vehicles use more of the bleeding edge semiconductors, so it might help facilitate the transition, that element of the climate transition to electric vehicles. But it sort of speaks to what the issue is here. There's these industries and these issues are beset by more than just one single factor. They're interrelated. High shipping costs play into all of this, and the sheer difficulty of getting hold of containers, of getting hold of logistics space, warehouse space, whether it be in the port of LA or much closer to home, interrelated, that feed on each other, and really make for a difficult time. The one thing worth flagging is, so if COVID has upset the economy's kind of equilibrium, it knocked demand out and it's knocked supply out, and it's now in a process of trying to rediscover a kind of steady state. The supply issues don't necessarily mean, well, they just kind of level off and we're all good. Is there a kind of sort of bullwhip effect where shortages turn into gluts, over-ordering, overproduction, and this time next year, or maybe even later this year, we're talking about this sort of disinflationary force coming out of what's happened in the goods production networks across the global economy. So I think that's a key thing to flag for the year ahead, is this isn't just a problem that's created and settles out. We've upset things. We're in the course of trying to find the new equilibrium in a lot of areas that COVID's fired. So there's probably more to come. I think that's maybe a good lesson for thinking about the year ahead and beyond. Right, exports. So I talked about the difficulties we've had. Look, it's bottom line, it's showing up in our figures. Global trade's been good. The recovery's been solid, all things considered. Of course, it's been led by China, because they make the things that we've all had such strong demand for, computers, office equipment, etc., etc. But look, you pick your advanced economy, and they've done better than the UK in recent over the past year. Estimates for the extent to which UK exports would be bigger than had we not left the EU, and sort of 10-15% is what some of the estimates are. So it's having an impact. and that's clear to see. There are things, it's evolving quite quick, so that there's a bit of reshoring or a pivoting to some domestic suppliers. That's coming through in the data. You see that in sort of food and manufacturing sectors. What if some exporters decide to do? Well, lower margin goods, they've simply just pushed to the side and no longer exporting to the EU because it's simply not it's not economical with additional costs. So that's also something that explains some of the lower exports compared to where we were. As I say, it really speaks to this difficult transition. Businesses adapting, definitely, finding their way through, but in the surveys, the very useful big surveys that the ONS does, taking the temperature of business across a number of areas, including supply chains, trade, climate transition, you name it, the recovery from COVID lockdowns. This comes through the difficulties both importers and exporters face and have done since the beginning of last year. And so, as I say, it's reasonable to expect this to continue. There's no easy fix to this transition. Tightening, right? Rates debates. A lot of talk today about the degree to which the US is going to tighten over the coming year, with Powell, Fed Chairman Powell, not ruling out 7 hikes this year, which would be quite remarkable. So over here in the UK, what have we got? So markets pricing in 4 hikes, which would take bank rate to 1.25%. Now that's simply a bit more tightening. Certainly seems reasonable, because when you look at inflation and what's happened to some of the underlying price indices, so I'm thinking about core prices, thinking about services price inflation, they have risen, and the fear is that the inflation expectations become unanchored. So the Bank of England having a couple of hikes in over the coming quarters does seem a reasonable view. There's huge uncertainty around this, because I think after that it's a case of they might stop to evaluate, well, what impact have those rate hikes had? Is inflation actually starting to retreat as expected? Has some of that froth come out? Is there evidence that it's getting into wages? Now, at the moment, I describe that as pocketed, not pervasive. That's what's happening with wage growth right now. It is not across the board, so across the board wage settlements, they remain contained. It's in individual occupations, but there's a big difference between some occupations seeing big wage hikes and across the board higher wage settlements. Businesses remain pretty good at holding the line. That is the message we're getting so far. They've also got higher costs to accommodate. We've talked a lot about generalised inflationary pressures. They'll also have the burden of higher NI come April. So we have seen this before in the many debates over the past decade on how Labour in the UK is able to wrestle those higher wage settlements from their employer. We think that remains the case. I don't think there's been a paradigm shift here. And I think that's really key. Of course, there's uncertainty around it. There is, this might feed into a generalised increase in wages that really start to support or give further impetus to inflationary pressures. But at the moment, wage growth is already falling short of inflation. It's already, you're already on a real income squeeze that's happened as we speak. So look, big uncertainty around it, but I think the sort of near-term tightening, after that, a bit of debate as to actually what happens. And the point I'm trying to make with this graph is, look, when you take market pricing, and that's what those upward curves are different vintages of, against what actually happens to bank rate, then the message is, well, it can disappoint. It's not, always that case, and this time, of course, might be different. But the lesson is, well, market pricing can get a little bit ahead of things, and the outturn is different. It's not what markets were expecting. So that's a lesson worth learning and thinking about the degree of tightening that we see in 22. Right, how are we doing for time? Just a little bit over than what I thought. I'm going to wrap up very quickly. Look, what's next in the climate transition? In many ways, the answer is lots and lots. The areas in which this will be pursued are just multiple, whether it's what's happening in agriculture, it's what's happening in energy generation, it's what's happening in storage, hydrogen, biodiversity protection. There are so many areas through which this plays out, and it's it's hugely capital intensive. There are large quantums of capital that are required to facilitate this transition. It's of course very early days. Now, education and the right conversations play a big part here. So I thought it was telling. So this question, again, coming out of the BIC survey, which of the following actions does your business intend to take over the next 12 months? So if you look at the far right, so you can take positives and negatives from this. So the negative being, well, look, there's a third of firms or over a third, who are not intending to reduce emissions for the next 12 months. There's a further third who are not sure. So there's 2/3 of your business base right off the bat. And then, but some encouraging signs within that there is action. And actually, even these small percentages do point to a large number of businesses. So this is something to really go on. This is something to really build on. As I say, on the other side, it's potentially a huge opportunity for conversation with businesses and trying to help them along that journey. I think, and that speaks to this idea that, well, many are obviously encouraged and really want to do something, but they're just unsure what they want to do, and perhaps need a little bit of encouragement around the benefits, the sort of medium to long term benefits that are derived from making the transition from doing your bit as a business in your specific sector. There are material benefits. That this isn't just about cost, a burden. It's far from that. There's huge opportunities presented by this. But I think in terms of next steps, it's about informing. It's about the right conversations, asking the right questions, and helping to facilitate it. Because we're in this for the long haul. We're all going at different pace. We're all learning. But for those that are further ahead and to know that bit more, the job is on to help educate and inform, I think. Right, I think that's long enough. I want to leave plenty of time for questions, so I'll open up to the floor.
Brilliant, thanks very much, Marcus. That was a really fascinating presentation, and it's great just to see the breadth of subject matter that you're able to give us insights into as well. So I'll remind people, please use the Q&A function or the chat function to submit questions. We've already got a few lined up. Before we get into those, one from me, I suppose we're seeing a lot of, I know you touched on political unrest a little, but particularly domestically, there is some uncertainty in the political sphere at the moment as to exactly where we're going and who will be making the decisions going forward. What sort of impact does that have in terms of your forecasting or the overall trends that we are expecting to see? Does that kind of dampen expectations a little, or does it do the opposite?
Yeah, so really good question. At this stage, and thinking about the domestic political situation, it's almost thankfully not having a material impact. When we look at those surveys, and despite the outbreak of Omicron, January tells us that businesses remain really optimistic about the year ahead. They're determined to press ahead with hiring. Their order books are good, and it's kind of, well, we'll press on. And while the UK does its best attempt to emulate the politics of Italy, we're just going to sort of get on with sort of business at hand. Now, there are obviously circumstances in which the political can affect the economic. We're not there at the moment. I think if there is a drawback, some things are sort of being put to the necessary conversations are being put to the side, like the next stage in the climate transition, how it is we should deal with the cost of living crisis, and as Sir Tony Blair was setting out in his Institute for Global Change, so digitization happening at pace. If you think we're in a new industrial revolution, then potentially impacts are just absolutely enormous. If we are to see AI become effectively like a utility and really make its way into so many sectors, that has profound implications for businesses and sectors, and we should be debating it. And again, we're not, because we're sort of focused on the political theatre. So yeah, really good question.
Great, thanks, Marcus. And I guess on a related point, Anthony Boyd, one of the participants tonight, has asked, kind of considering the more global political situation and what, if any, consideration is taken in relation to the Ukraine-Russia situation in economic forecasting, and the kind of potential impacts of that going forward?
Yeah, so it's a really good one. It's caused a bit, of fright. It's a reason for a bit of fright in markets, and the knock-on effects of that are sort of a little bit of sort of diminished animal spirits. Markets obviously provide important wealth effects and knock-on for spending, etc. So there's a little bit of an impact there. The thing about Russia is, from an economist will immediately start to look to, well, what's its importance in terms of an export market destination, as a source of investment, as the size of its consumer market, and it's simply just not a hugely important market. So those metrics aren't particularly worrying. Of course, energy is the lever in which there are concerns, and that these inflated gas prices. Now we know that we're in for the 40, 45, 50% increase in energy price cap come April. That's unavoidable because it's an average of wholesale gas prices since August. So that's kind of set. At the moment, forward curves indicate that the following changes to the price cap, so October later this year and then April next year, the forward curve suggests that they will be far, far more subdued, talking sort of single-digit percentage. But I suppose, further tensions have the possibility to make that a very different story and prolong this and make the pain even worse. So that's the key bit to watch. At the moment, there is a big sizable uplift in energy prices coming. We know that, we can't get away from it. Beyond that, they're contained. The situation in Eastern Europe has the potential to change that.
Great, thanks very much. On a slightly different note, we've got another question submitted here. So with inflation running at more than double the Bank of England's 2% target, the question is, has the Monetary Policy Committee given up its battle against rising prices?
Yeah. So I don't. I certainly don't think so. So one, there was a subtle shift, and you might call the timing unfortunate, in what central banks were prepared to accept in terms of inflation. This particularly the US signalled their willingness for inflation to run above target for some time, and that is for a country like the US, because for so many years in the run-up to COVID, inflation was falling short of target. They couldn't get inflation back to target on a sustained basis. The Eurozone really couldn't do it. The UK was slightly different because sterling fell after following Brexit, and that had caused a level shift in prices up. So I certainly don't think they have. I think that they have a bit more tolerance for high inflation than you might expect. They do look through a lot of periods of high inflation that are driven by high commodity prices. Some of these are supply driven. It's not really clear what higher rates does about supply driven inflation. What does higher bank rate do about supply, semiconductor shortages? Not really sure it does a lot. But there's no doubt. The bottom line is the degree to which inflation has risen has caught them unawares. They made a forecast in November, 1 month ahead for their forecast for December's inflation rate. They were out by almost a percentage point. That's the biggest forecasting error in years, potentially ever. So the point is that the degree to which inflation has risen even in the past couple of months has caught them unawares.
Excellent, thanks very much. Just a reminder, if you've got any questions, feel free to pop them into the comments, the chat function or the Q&A function there. The other one that kind of springs to mind is the productivity gap, and we've seen, I think, the gap between the UK and the rest of the G7 widening over the kind of COVID period. What do you see as the response to that from the UK, and how can we kind of recover from that?
Yeah, so I think this comes back to the fore quite quickly in the coming months, and certainly by the end of 2022. Again, as Tony Blair said, we should be kind of really waging all-out war on this. This had really started to be felt in the run-up to COVID. You recall at that point, growth was kind of slowing. The UK was sort of showing a little bit of sluggishness, and this year after year of weak productivity growth was becoming a real problem. So you have to say, the simple question is, have we done the things that are set to turn that round? Has there been substantial investment in infrastructure? Have we suddenly revolutionised our education system? Is business investment in intangibles and software, the things that really are driving productivity, has that taken place with sort of real energy? And at the moment the answer is no, but there is grounds for optimism really on a lot of those. We know that at last money being funneled into public infrastructure is set to be the highest it has been for decades. With time, with a lag, that will eventually help productivity. I laid out the case for business investment to improve, and where the US leads, I think we follow, and this US investment in sort of intangibles and things like software and R&D, etc., is bearing fruit. Their productivity performance has been really good. Even prior to COVID, it was starting to sort of show real signs of life. So I think we get a bit of that. It just takes time, and I'm a techno optimist, and I do think this decade will prove to be better than the last one in terms of the changes in technology, of which there were obviously huge amounts the last decade. It just didn't feed into productivity. I think that starts to change in the coming decade. History tells you that's the case. I possibly said this before. I roll it out all the time. Electricity was invented in the 1880s, and it wasn't really until the 1920s that it started to make its sort of presence felt in improving productivity manufacturing, because we had to reorganize factories, how we train people, how we manage people, how we work. Everything had to be reorganized around it. That took some time because it's social change. It's probably the same with a lot of these technologies, particularly AI.
And presumably the same with elements of the response to the climate crisis as well. Will take, hopefully nowhere near as long as that, but it will take time for that to really pull through and for the response to meet what's required.
Absolutely. Look, so you break down, all the sectors, the sectors I mentioned, hydrogen, hugely exciting, so if you can get the cost per megawatt down in hydrogen, wow, huge levels of capital investment, as well as the, fantastic benefits in terms of carbon, how much carbon we produce. Agriculture, whether it's better land management or it's cultured meat, vertical farming, huge exciting technologies and changes. They're just, they're on the way, and that, like you say, potentially herald a revolution. It's just it's a lot of money, it's a lot of work, it's a lot of time. Are the right incentives there for all of those? Possibly not. Is it supported by sufficient funds on the capital side from the government's balance sheet? In a lot of areas, possibly not. But those are all debates that we need to have.
Great. We've got another question from our audience. The question coming back to inflation. So is high inflation going to impact, or presumably high inflation is going to impact the recovery in 2022? Is the question. And if so, how do you see that playing out?
Yeah, so this is the good question, because we have that, if this had been 2010, 11, we've got inflation going this high, it's putting a squeeze on all households, inflation's running ahead of wages, it's almost a straightforward story. This is just going to put the brakes on the recovery. However, on the other side, we have a recovery from a pandemic with quite a lot of ground to make up on consumer-facing services, savings piles that are enormous, and savings habits that have yet to properly normalise on a consistent basis. So you have this kind of juggernaut of a recovering consumer, us wanting to do the things that we used to do, and what I think that squeeze does is just not make that as vigorous as otherwise would have been. But you're right. In a normal year, had the UK economy been sort of ticking along at 1.5% growth, and things were steady, and in other words, how they looked pre-COVID, you'd be much more concerned about this. You'd be really worried about it. But ultimately, and really that's probably in the government's thinking as well, because they see these huge savings piles and the strength of household balance sheets, that it really is continuing to play out in the housing market. Their bet is that it does continue to support a consumer recovery. It just might not be quite as strong as it otherwise would have been. That's probably the way to characterise it. But as I said, the risk is that it does more. It does more than that. It does more than just apply a tapping of the brakes. It's something altogether a bit more damaging. That's clearly a risk.
Absolutely. Another question. Thanks again to our audience. Again, we've not got much time left, but please feel free to keep sending questions in. Another one we've got here is, when people start going back to their normal routine, going into the office, commuting, etc., what sort of assumptions have been made in the forecasting at the moment for that? And if we get there sooner than expected, given the announcements over the last couple of weeks in both Scotland and England, what sort of impact will that have on the recovery?
Yes, look, really good question. So it's in there. So when I talk about that recovering consumer and sort of drill into what builds that, what are the building blocks there, that's a big part of it. It's the when I say this, that all-encompassing term, consumer-facing services. So I'm talking about arts, entertainment, recreation, hospitality. I'm really talking about the things where the shortfall, like public transport, and travel more generally, and our airports collectively, when you add in their supply chains, airlines, lump it all together, you come up with 5-6% in GDP. Our airports really, really matter. They're big centres of employment. So that the recovery there in public transport and arts, entertainment and recreation, hospitality, and the loosening the restrictions just unlocks that. So that's the bit that's really driving that consumer recovery. So yeah, absolutely right to pinpoint it. And look, I think it's going to help us. I'd mentioned earlier on this, still a bit of a question mark over office space. So capital growth has been really good, and in London in particular, firms looking for new office space that's tailored to modern employee demands, that has the right sustainability credentials. Demand there is good, right? So a lot of those firms, the announcement from CISI yesterday or the day before, the 100 million they're going to spend on redoing their facilities at Canary Wharf, that speaks to this transition. There is still a place for the office. So the getting back to work helps us is going to discover sort of almost like a price discovery mechanism. What is the new equilibrium, and what is it? How much office space do we need? How does it need to be configured? And in tandem with that, we have lots of firms wanting to press ahead with their the climate transition, and that means evaluating their office space and getting something that's right. So look, it all helps with that, and we're able to press on with that.
Excellent, thanks very much. And a final question from me, if I may. So you said you're the optimist, and it'd be interesting to know, if we had you back in a year's time, which it would be great to do, what would you be hoping to be saying to us in terms of the year 2022 and going into 2023? What would your hopes be?
Wow. Okay.
A bit of a challenge, I know, but see.
No, it's good. I like these type of questions. So I'd like to say that that we had put the pandemic behind us, and we'd all enjoyed were able to enjoy doing the things that we've missed so much out on, and for many of it, particularly travel. The ease at which you jump on a flight and go and discover a European city. So that's a bit sort of on the more personal side. But look, yeah, I think it's put the pandemic behind us, growth's kind of normalised, and we are tackling proper and seeing evidence of it, that we are taking advantage of the digital transition. It's helped. There are signs that productivity might be come back to life, or coming back to life soon. The business investments picking up. That geopolitical tensions have subsided, and that it's there's progress on things like levelling up, or they're set to be. Now that's maybe quite a lengthy wish list. We'll maybe only get a handful of those, but in an ideal world, that's what the end of 2022, early 2023 looks like.
Excellent, thanks very much, Marcus. I'll hand back to Helen, and I think she'll close off.
Oh, I should.
Yes, on mute. Thanks very much, Marcus. That was a great presentation. Some clear themes coming through there. And thank you, Neil, for hosting a great Q&A session, as ever. We've got a few events coming up, as I mentioned earlier on, and the first one will be on the 22nd of February, which is a joint event with the Scottish Financial Enterprises Young Professionals Network. Wow, that's a mouthful. Where Rory McIntyre, who's a member of our committee, and Millie Batchelor, who are both Young Banker of the Year semi-finalists, will share the benefits of being involved with professional bodies and networks and how it's influenced or impacted on their career, which is an interesting topic. And then the 8th of March, it's the time, that time of year again, for Edinburgh Lothians Fife District Centre to have their AGM, which is open to all local members. We start at 5:45. If there's anyone interested in finding out a bit more about the committee or want to be involved, then if you go to the advert on the Institute's events, both Neil and I have our contact details there, and we'd be happy to have a chat with anyone on an informal basis. And then we'll follow on after that an event that's open to everyone, which was actually postponed from the end of last year, which is a conversation with Sheena Hales, who received the British Empire Medal last year for her services to the finance industry through her charity work. And so that's looking to be a good event. Plus, there's another couple of events that we've collaborated with CISI, who are hosting, and we're sharing them with the whole institute as well. So they're also on the website as well. So I'd just like to thank everyone who's joined us this evening, whether you're an institute member, member of the CISI, local member, or just you've come along to hear what Marcus had to say. We do appreciate you joining us, and thank you to Heather from the Institute for all her help as ever in promoting our events and doing the technical bit as well. We would be quite lost without you. So I hope you all have a lovely evening, and thank you once again, and hopefully you'll catch up soon. Bye.